Hi, Sri Sokamoto with Cal here with the August market update. So the question everybody's been asking is the recession going to equal a housing bust? And the answer is no, it's not. If we look at the previous years, obviously 2008 is the most recent recession that everybody remembers, and everybody remembers the huge drop in home prices, and it affected almost everyone. Prices went down almost 20%. But if we look historically back over the last 5 recessions, housing prices actually went up in 3 out of the 5 recessions. And one of those, prices only dropped by less than 2%. So 2008 is not the typical situation for a recession and housing. If we look at what is the top 3 triggers for this recession that we're in right now, or economic slowdown, whatever you want to call it, trade policy, stock market correction, which we just saw last week, geopolitical crisis, those are the top 3 reasons for the slowdown that we're in. Number 9 is housing slowdown. If we look back at 2008, the housing market and lending issues were 1 and 2 for the recession in 2008. So we're in a different time. The reasons for the slowdown is completely different than what they were in 2008. So what the experts are predicting is that over the next 4 years, we're going to see appreciation of anywhere between 2.5% to 4%. Normal appreciation, not specific to cities but throughout the U.S., is about 3%. So we're going to dip a little below the average in 2002, 2001, but that doesn't mean prices are going to drop. So it's important to understand that. And with housing affordability, obviously the highest affordability was back in 2011, 12, when the prices dropped tremendously. Now, if you're looking at today, housing affordability, of course, is lower than when we went through the crash in 2008. But if you look at the historic numbers, we are still more affordable than any of the previous years dating back to 1990. And so why is housing more affordable now than it is in 1990? Part of that is because the typical mortgage payment is lower, right? Because interest rates are so low, payments projected in 2020 are a little bit higher, but just slightly than they are right now at typical payments. And of course, this is across the United States. In California, our payments are a little bit higher than these numbers. But if you look back, they're all lower than they were in 2006. And again, so this is the number of what our typical percentage of income is going towards our mortgage payment. So you can see back in June, our typical payment was 18.2%. Now we're down to 16.6% because of the lower interest rates. And again, the historic norm for that is 21.2%. So we're well below those numbers, which is why affordability is so high right now. So if we go back and we look at this slide, so why are we so high here in 2019? It has a lot to do with this, the percentage of your income going towards your mortgage payment. So that's kind of like the overall look at what the market is doing. If you want specific information to your city, your neighborhood, just reach out to us. We'll be happy to give you numbers that are specific to you. If you have any questions, please feel free to reach out, 714-922-0605. Thanks, have a great day.